him and I are heavily invested in real estate, and we love real estate. We're doing very well in it because we could see this coming. You know, I remember around 2008, just before 2008, there were cranes all over the skies of New York, and there were huge condo projects and all this. It's coming down.
It's a fake bounce. It's the Biden bounce, and it's the same thing around the world. They're dumping in all this cheap money, printed on nothing and backed by nothing, and artificially blowing it up. Well, let's go back a year ago. And let's go back to last August. Let's go back to last June. Listen to everybody. Oh, it'll come back. Oh, it'll come back. It didn't come back.
The Fed and the Treasury are Marxist. You see, in a true capitalist society, this guy, there was an economist named Schumpeter, says capitalism is failure. The capitalist is supposed to wipe out the inefficient. So like when I was, not too long ago, there was Blockbuster Video, and my goofy friend wanted me to invest in Blockbuster video stores. And thank God I didn't. But what happened is when these banks loan money to idiots, instead of letting them crash so that real investors could go back in and clean it up, it was too big to fail. And that's why we're in serious financial trouble today.
Guys, good morning, everyone. How you guys doing today?
Morning, Louis. Good morning.
Good morning.
Morning, Louis.
Good morning.
How was everyone's weekend?
Great.
Good.
Any wins? Any good stories that you guys want to share?
Yeah.
Come on, I know you guys did good this weekend. Somebody had to have some wins.
Yes, it was
Sure.
Mother's Day and my family adorned me. I did not do too much work this
Awesome.
weekend.
Yeah, a win.
Win. I had a chance to sit with Humphrey and Micah for an hour and a half, and that was a nice motivational time together. Those guys, they're like gasoline and dynamite put together.
Yeah, tell us about, well, first of all, can you explain to everyone here who Micah and Hamudi are, because maybe not everyone here has had the opportunity to speak with them or meet them yet?
I believe Micah is number 235 in the EXP world of like 80,000 agents. So she's very well placed in the revenue sharing chain. And they happen to have sponsored Louis, if I'm not mistaken. So up in the EXP chain world, they would be somewhere above us, quite a bit above us. But when I was, when I heard that they were in Sarasota and I live in Sarasota, I said, do you mind if could I have 1 hour of your time? So I figure being around people like that, that have high level of success and boldness to approach anyone at any point, I just asked them some questions. It was a great time of interaction and very practical, and they are normal people with high motivation and willing to help. So they said to me, tell your people to get on the calls on Monday with Louis and Friday with us. So if you want to learn, that's an invitation that's wide open to all of you. Just get on with Hamudi and Tanya, and it was very motivational for me. I feel like tackling the world today.
That's really good. And Micah was at number 333 in the company. So talk about taking a long shot on a company no one's ever heard of before. When she did that, she had a brokerage of her own. She had an office. She had expenses, overhead, all those things that normally brokers have. And she met with a guy who had no idea what he was doing at eXp Realty. He didn't know how to explain the model well. He was just the only guy in the area that was with eXp Realty. So in a way, he kind of lucked out. And they saw the value in the company because of what he had explained. And fast forward to today, they had the vision to be one of the first ones to take that opportunity. And they've done really well for themselves. Hamudi got licensed, I think, like 2 years ago. And Hamudi in 2 years, without ever having to sell one house. So I don't want to hear anyone say, oh, I don't sell enough houses to be an influence on anyone. And Hamudi has never sold a house, ever. He got his real estate license so he can help his wife. and he's built his own revenue share team of a lot of people. I'm not exactly can't keep count of how many people he has already, but he's the type of person that, let me tell you a quick story about him. They took a flight to Sarasota one day, and he saw a real estate agent had posted a billboard somewhere. So he called the agent on the billboard, introduced himself, and asked him if he ever heard of EXP Realty before. And that real estate agent is David Mills. He's one of the most successful real estate agents in all of Sarasota, and he joined the organization from that phone call. So you can never make an excuse. And these are the kind of people that are in our organization. These are our business partners. They're directly connected to all of you. So if you ever want to reach out to them, please do. I know there's a lot of people who have never taken that opportunity, but Brent did. He met with them in person because he came to the Sarasota area. And like he said, he's fired up. So I encourage anyone, if anybody needs a good pep talk or just some key insights from some very smart people, they're willing to help. So take advantage of that. Awesome. What is one of the key things you picked up, Brent, from meeting with them this weekend?
Don't be afraid. If you really believe that EXP offers at least as good as, if not better, then just approach someone with the attitude that you can genuinely help them by not leaving something on the table at a closing. So that was one practical tip. And the other practical tip, he just said, you know, the energy that you bring into a room is the energy that others will take out of the room.
Yeah, absolutely. Well said.
Yeah, and he was just an unusual. I mean, I see Micah a lot more than Hamoudi, but Hamoudi is just a really one of the most intense guys I've ever met.
Mm-hmm. Yeah,
So
his energy is infectious.
Yeah.
That is very true. We're very blessed to have them. So guys, take advantage. If you have not ever spoken to them, just reach out. They are more than happy to.
if you could just explain when the call is on Friday and what's different about Friday than Monday, Louis, just in case anybody does want to accept their invitation to join that group.
Yeah, so you guys know our Monday calls are masterminds. We talk about what's going on, what's trending, what you guys find important. And on Fridays, they're very intentional about leadership calls. So if you're looking to build an organization and you want accountability and you want to be inspired, then you jump on Fridays at 11:30 on Micah's link. That link I'll post in the chat in just a second. But yeah, so today, thank you for all that, Brett. Today, I want to talk to everyone about what occurred last week. As you guys, well, maybe you know, maybe you don't know, but every quarter, a publicly traded company has to report their earnings, and it has to report also what's called their guidance for the next quarter. Okay, so recently we had EXP report, which was amazing. They're just crushing it, guys. EXP is just like everything across the board is up and to the right, which is amazing. It won't always be that way, but it has been that way. And you know, I'm not here to tell you guys what to do with your money, but the stock is much cheaper today than it was ever in the last, I would say, year. And they're doing better and earning more than they ever in history. So, and if that doesn't tell you something, that, you know, then nothing does. But I think right now EXP Realty is on a great trajectory. But today's call is not about EXP. It's about Zillow. And Zillow just reported last week as well their earnings, and we're not going to talk about their earnings today, but we're going to talk about their forecast or their guidance that they gave for the next quarter and into the next year. And why are we talking about their guidance? Because they have to report information that is relevant to all of their investors, because people who invest money into this company have to know what they're in for. That way they don't paint a rosy picture and then come next quarter, next year, they pull the rug out from underneath them. It has to be something in line with what they set the tone for. So when you go to a listing appointment and you know the house is a dump and they're asking for way too much money, you're not going to go in there and say, well, the guidance I have for you is that the home is going to sell over the weekend. You know, that's normally not what happens. I mean, if it's overpriced, it's overpriced. It's going to take time. It might need a price reduction or two. So you need to set the stage for that, because if not, you're going to be disappointing your clients. Well, the same thing happens when a company reports. They have to tell their investors, hey, this is what we can expect for next quarter. You know, since we're a real estate driven company, if real estate is not doing so well, guess what? Agents are not going to be investing too much in ad spending. We're not going to be able to get too much money coming in from our mortgage division. You know, we're going to get a lot of less earnings. So if they paint that projection out into the future, that investors know according to their guidance what they're going to do, if they're going to invest more or if they're going to wait and to see how the market plays out, to then go in and then be more aggressive on the buying on the next dip or so. So with their last report, you know, instead of going into the entire report and getting into the weeds and making it very boring, I'm gonna play a video for you guys that I found that was very informative, and I also found a very good article that kind of summed it up about where they feel the market is going, because you guys obviously should know this, right? If you're dealing with the public and you're talking to people about real estate all day long, you should be able to at least hold your own when it comes to knowing what the market's going to do. Right. So great topic for today. I'm sure you guys are already starting to see it. Maybe homes are sitting a little longer, maybe less offers on homes. In parts of the North America, we're already starting to see home prices actually come down and inventory going up. So in Vancouver, Canada, they just released information that Vancouver, Canada, for 4 months straight, they've already experienced inventory influx and also prices coming down. Now, while you guys say like, oh, that's Canada and that's, you know, real estate is a very local type of business. Yes, that's correct. But there's usually what occurs in the real estate market is trends, and it's a wave that usually starts on the West Coast, and Vancouver is on the West Coast of the North America, and Vancouver is number 1 or number 2, the most affluent cities in the entire Canadian, well, I think it's a province. I'm not even sure what they call it up there, but it's one of the most expensive markets in the entire Canadian country. So why I'm telling you that is because people that have a lot of money usually are people that are a little bit savvier about the market and about what's about to happen. So if you're starting to see those people kind of pump the brakes and not buy right now, it's probably because they see something coming, because they have financial planners, they have advisors, they have people who kind of tell them or steer them into a direction where, hey, listen, if you're looking to buy a house, maybe you want to wait a couple of months or maybe wait a year or so, because the market is starting to soften up. And if those people are already starting to set that trend, well, usually that trend kind of flows into the other markets that are more entry level. The same thing happened with the 2008 crash. If you guys were around for that, the 2008 housing crash started in California. It started on the West Coast, and it slowly found its way over to the East Coast and kind of just devastated the entire country. But it started in the more affluent areas. So pay attention to these things, because it could turn out to be something, or it could be nothing, but you might as well know, what's around the corner, because that way you can educate your people better. And if you're also thinking about buying or investing, at least you're educated a little bit better as well. All right, so let me go ahead and share my screen and play a quick video for you guys that'll kind of explain what Zillow just reported a little bit better, okay? Let's see if I can share my screen. Awesome. Let me know if you guys can hear this okay.
Report I was talking about. Zillow, arguably the most in-tune real estate company in the world with data from millions of inputs, just released its earnings report, and the findings are suggesting that the market is running out of steam. In the middle of the report, we find the first piece of significant evidence. Here we see that new for sale levels are up 36% from February, indicating an inflection point that inventory may soon be moving up. But there is an asterisk to this finding. Overall, new sales levels are still down 9% from last year, showing that this could very well be seasonal, as most people list their homes closer to the summer months, pushing listings towards March. But that wasn't the big finding. Just below that, we have Richard Barton, co-founder and CEO, saying this. So while we know people are eager to move, market conditions are making it increasingly difficult. The net result of all of these factors is that total consumer transactional value growth trends are meaningfully softening, and even the most respected experts have disparate views of what will happen next. This guy loves to use big words, but essentially what he's saying here is that the data is changing and pointing to the fact that homes are becoming increasingly harder to afford, and even the most respected experts are showing signs that they don't really know what will happen next. When he says this, disparate views of what will happen next, it just means that expert opinions are all over the place, showing signs that uncertainty is growing. On YouTube, there are people like Raventure who claim that the market is going to crash like it did in 2008. And then there are people like myself who don't claim to be experts, but believe it's just going to be a slowdown with prices remaining relatively stable at current price points because inventory is just too low to accommodate a real estate crash. Either way, you have to remember that earning reports are essentially a sales pitch. So you have to read between the lines in this report, and reading through it, there are some major concerns. For example, here towards the end, the CEO says some stuff about the deceleration of the real estate market, but he stops short of saying it's going to crash, which should be expected from a CEO of a major real estate company. But when you read something like this, it does raise eyebrows. Here, the CEO is basically saying they can deal with the current headwinds, but if there's a terrible storm, aka a major crash, they will still be on top. The very fact that he's even giving this hypothetical situation any attention is a bad sign. Like I mentioned earlier, when you read an earnings report, you kind of have to take what they said and what they didn't say, comparing and contrasting the words, summarizing with the implied truth. After reading this one, you have to admit at the very least, it's slightly concerning. In summary, Zillow's report suggests a softening market for 2022. They don't say there's going to be a crash, but they do spend way too much time talking about a hypothetical major slowdown. Combine this with the fact that we're seeing an inflection point and that they have sold off nearly all their iBuyer houses, and you have a solid case for a future crash. But it's not all clear. On the other hand, fresh data from Redfin suggests home prices are continuing to appreciate. Specifically, they're up 17% year over year, and demand continues to be strong, down just 1%, with a record 56% of homes sold above their list price, up from 47% a year earlier. This despite the fact that mortgage payments are up 42% year over year. This is likely the most shocking chart in real estate history. Just take a look at that line. Despite this crazy increase, median prices are still going up. That to me showcases just how solid this market is. You have to think in order to change the outcome, you have to either change demand or supply. Right now, supply is being pinched by the fact that people who bought earlier or refinanced to rates below 3% will have a hard time putting up their houses for sale when they have to take out new loans at 6%. Nobody in their right mind is going to trade their 2.7% mortgage for a 6% mortgage. So people are staying put, delaying their sales until rates come back down. Meanwhile, the largest generation in America's history is eager to buy. FOMO is taking over the market, and the few houses that are up for sale are being bid up to absurd levels. Of course, we will eventually have a crash. I just think it won't happen until we see price levels increase to absurd tier, something resembling Canada's, Australia's, and New Zealand's markets. Thank you guys for watching. As always, please make sure you hit that like and subscribe button if you enjoyed it.
All right. Okay, guys, I need your I need your input. What do you think? What do you think about this report that Zillow kind of just put out? I have more details on it in an article I found, but I want to open up the discussion right now to ask everyone, do you think that what Zillow is saying here, how they kind of said that there's a possibility of a major slowdown, do you think that's going to happen in 2022 or maybe till the beginning of 2023? Do you think that within the next 12 months, we'll see something that's going to resemble a housing crash, or do you think it's just normalizing now and just slowing down a bit? What is your take on this? Or what do you guys?
No, we're not gonna crash. I know that for sure.
Tell us why. Give us an example.
I mean, I'm in the market. I'm a buyer's agent, and I've been running around with my buyers, getting all these offers declined just because it's becoming normal in Central Jersey to overbid 40K over.
Mm-hmm.
He was saying in the report that nothing is going to change unless something changes in the demand and the supply.
Yeah.
It's either it'll become less demand or more supplies. And I'm not seeing that right now. He made another point that was very important, and that actually we did this, my brothers did this. We all refinanced. We all took advantage of the 2.7%. And now the interest rate is 5.5%. So we're comfortable. We have no reason to sell.
Yeah. So a lot of people are going to stay put.
Yeah, a lot of people will stay put because it makes more sense. Why would they sell and go buy something more expensive and pay more with the interest rates? And look at the rent. Even if you want to rent,
it's worse.
It's so expensive to rent. And there is also a bidding war on rentals.
Mm-hmm.
The last rental I helped, we had to offer $50 extra a month.
Mm-hmm.
Even that, you're offering more.
Yeah, it's crazy, right? It's unbelievable. It's
right.
The demand.
Miami are averaging about 56%.
I'm sorry, say that again, Steve.
Rental increases in Miami are averaging about 56% year over year increase. So if you were paying 2,000 last year, you're expected to pay 3,000 this year.
Yeah,
And that is totally legal.
that's crazy. Yeah, there's no rent control in some of these markets. But I'll tell you what, the markets that do have rent control, the owners of those properties are selling. They're getting out of those markets. I'm not sure if you guys are noticing that and going into the markets where, there's more liberty for landlords. I'm not sure if you guys see that as a trend as well.
In my market here in Georgia, I have seen some stabilization. Like how you guys in Florida and New Jersey, the over asking for sales was not as extreme as you have experienced, or nor has the constant of putting in multiple offers
Yeah.
on a home. I have not seen that spike or had to have experienced what you guys are experiencing. So what the solution here in my area is new builds. So yes, I've seen the prices not come down, but stabilize dramatically over the last 2 months. And homes are staying on the market for at least 15 to 30 days longer than what they had been at the beginning of the year.
Okay, so you are seeing a slowdown in
I'm seeing a slowdown for resales, but an increase in new builds. And even the new build price where they were at 400 for a single family, I now have 12 communities in my area that has come up in the mid 200s for new build, 4 bedrooms, 3 baths.
So you're saying that there's new constructions now that are selling for the mid to high 200s as opposed to 4?
Yes.
It has to be a totally different type of house, so right? That's a
It's
drastic.
a little bit more less land space.
Mhm.
So the houses that sold at 400 had a quarter of an acre to a half acre, and these are just a little under a quarter of an acre. So yes, they are squeezing them in, but they are making a market for those that were misplaced because the investors sold their homes, and now these people had nowhere to go.
Got it.
So
Okay. So it's a
in our
niche that needed to be
area,
filled.
people made noise, and the government loosened up the noose
Yeah.
on the home builders
Got
to
it.
allow them to develop land.
Yeah, of course. What does anyone else want to tell us what they're seeing? If there's any kind of still any hint of a slowdown, or you guys still see just as much? Hey, Jose.
I have a question for Belinda. Belinda, what about those new properties? You think they're gonna, do you think they're gonna be upbidded? I mean, that's a
No.
huge difference from 400 to 200. So you don't think
No.
those $200,000 properties will be upbidded to maybe 350?
No, what's happening is that they cannot take earnest money until they have at least 5 homes 80% built. And then you have to go on the wait list for it. And in order for you to be on the wait list, you have to be pre-approved by one of their preferred lenders. Now, once you have made it to the offer stage, you don't have to go with their lenders. You can still go with your own lender. But wait lists are generated. So they're taking a wait list to really weigh out what's available and how much more is needed. Because people are getting approved. And I'm one of those that's helping them by restoring credit. So that's my, side gig there, is making sure everybody's credit score is where it needs to be.
Mhm.
I've seen a change in the last couple of months, Louis. For the 9 months that I've been licensed, I focused a lot on the new construction because I thought that was a legitimately better buy for your buck.
Yeah.
2 different builders have called me within the last 30 days and said, I have a home at 375 that is 90% built. If your client wants it, we'll give it to you. And that was like totally new because there's been a waiting list that has been as long as your arm.
Yeah.
So my client took it. Then yesterday I got another call from another builder, same type of thing. He said, I have 2 homes. One's at 590, the other's at 620. No waiting period, no waiting list. We're ready to sell to anybody that will take it. Well, that's a major shift That is a factual major shift. And I think the reason for it is 2 years ago, you could get interest for in the 2 percentile. Now, when you're at 5.5, pushing 6, people are out of the market. So I think that shift has happened. Cassandra put me on to the awareness of a teaching in EXP University on absorption rate. And I thought that was excellent. It talked exactly about trending. So I think maybe Cassandra wants to make a comment, I don't know, but that was very helpful to me to see the why behind the what. And I think the downward shift is happening. I see reductions now on the MLS. You didn't see reduced when I first got licensed. Now you see reduced. So I think the prices will come down and inventory will go up. And the reason behind it, I think, is primarily interest rate.
Yeah, I do think so. Well, I will tell you one thing. There is a silver lining in all this, is the fact that for everyone here who's literally been frustrated, pulling their hair out because their offers weren't getting accepted in 2022, well, if or 2021 into 2022, if the market does normalize, you guys will sell so many more homes. You know, like, we just need more inventory. We need more options. We need less buyers in the market. You know, as long as you've got your skill set and you weren't depending on people falling into your lap, you could do way better in a market that's normalized, where we have 6 months of inventory on the market. Because a lot of people don't know that a healthy absorption rate for a market is 6 months of inventory. In parts of Florida, we had 2 weeks of inventory, which is like never been seen before. So what Brent is saying is 100% accurate. If you guys aren't familiar with what absorption rates are for a market, you should really do your homework on that. Really start looking to see what your markets that you're working in have, because if you don't see that, and maybe I'll do a training on that next week. If you don't see that, then you know you really don't know where you're going up against. And if you're going to start marketing in certain areas, you know, sometimes you might be just wasting your time and throwing your money away if there's no inventory in those areas. I mean, what are you really going after, right? So very important for you guys to know that. But I want to share something with you here, and it's a statistic that I think we should all be very aware of, because you guys know that the rule of anything is that nothing goes in one direction forever. You know, it might go in that direction for a while, but things always tend to find a medium, or sometimes revert back to their lows or their highs. But usually, you know, things level out. Okay, so I want to show you something here. This is the Housing Affordability Index, and I want to point something out to you guys here, that in 2019. There was a percentage of what a person would pay for their mortgage as part of their income, which was about 15.7%. So that means that $15 out of every $100 that person owns or earns, or that family earns, was used for the mortgage. Okay. Then in 2020, it dropped down a little bit, because you guys know what happened in 2020. Then in 2021, we saw a tick back up. And then, well, this is going by quarters, okay? So long story short is, if you fast forward from 2019 to 2022, and this is calculated, guys, before these recent mortgage hikes, because, you know, right now we're starting to see mortgage hikes just this month, right? Well, check this out, 18.7%. It's gone up to 18.7% from 15.7. So this means that it's costing people a lot more money to be able to afford the same house. The average mortgage payment was about $1,000 in 2019. Now it's $1,384. The average interest rate went from 4% back in 2019 to 3.8. I don't know anybody that has a 3.8 right about now. Anyone that's getting a 3.8. This is going to be more like 5%. So imagine when this goes to 5%, what this percentage of income is going to be. It's going to be in the 20s. It's going to be insanely high. And this year, yeah, and this year is going to jack up to probably like $1,700, right? So that's going to be, that's going to be taking the scales of way over. How would I say? It's going to be too much, guys. I mean, it reminds me of what happened in 2008, where people were buying homes that were way too expensive and were way too out of their capacity to pay for. and they would have to rent attics, rent basements, rent studios in the garage. Like they would do anything to just make the mortgage payment. And they would also take out these mortgages that didn't even pay down the principal. They would only pay the interest. And sometimes they wouldn't even pay the interest. There were mortgages out there that would pay a portion of the interest only, and then push the rest of the interest that was due on the back of the mortgage. Like that was like the craziest stuff in the world. But to us back then, we just felt like that was normal. That was what had to be done in order for you to afford a house. And today we're starting to normalize paying $40,000 more for a house, $100,000 more for a house, just to be in the running. And a few years from now, we're going to look back and say, oh my God, can you believe what craziness we were doing? We were paying 50 grand more for a house just to be in the running. And we're going to start to see that, you know, I'm not going to say right away. These things take time. The real estate market, it takes a long time to shift. You know, like Robert Kiyosaki said in the beginning of the video, if you guys were here for that, real estate is a very illiquid asset. Illiquid asset means that you can't just say, okay, well, I want to pull out 100 grand out of my house. Let me sell it today, so that tonight I can go and, you know, invest that into Tesla stock or something, right? You can't do that. You have to put your house on the market. You have to wait for a capable buyer to come around and make you an offer. You have to wait for that buyer to go through all his inspections. And if you're in Jersey, you got to go through attorney review, and you got all these drawn out processes and city inspections and all these things that you have to go through. It could take you 3 months to sell your property, right? So it's not a liquid asset. It's an asset, but it's not a liquid asset. And like Robert said, if it's your home, your primary residence, and it's definitely not an asset, it's a liability. So with that being said, the market takes a long time to shift because it takes so long for a seller to sell at a higher price, at a normal price, or at a below average price, right? It takes a while for us to see those trends. So when you start to see the inclination of a market going in one direction, well, what happens is you start to see the full blow of that, that shift in about a year, or maybe sometimes even 2 years, okay? The housing crash of 2008 wasn't over in a month. For those of you who were here, it took the better part of the 2010s, you know, to really work itself out. You know, we were crushing short sales all the way up to 2019. So think about that, guys. That's almost a decade, you know, of repairing a housing market. And you know that it could happen again, and not necessarily have to happen, but we could see a definite correction, and it'll take time for us to feel the full effect of that, because it's so gradual that we don't really feel it on a day-to-day. It kind of measured, we're better off measuring it in quarters or years to see the differences. And that's why I'm bringing this up to you, because you're going to start to notice this. For a family that was getting a house in 2019, their qualifying income was about $50,000. Now their qualifying income is $66,000, which is good. It means that they're earning more money, right? They're earning more money. But if you look at the overall index here, the composite affordability index, this basically takes into consideration all of the numbers that are here, and it gives it a rating. So the higher the rating, the cheaper it is for them to afford. The lower the rating, the more expensive it is for them to afford. So with that being said, in 2022, before any really humongous rate hikes, we're seeing that it's at its lowest affordability index in the last few years that we've been in, last 3 years that we've been in the market. So you can expect this to even go down a bit lower into 2022, which is maybe what we need, right? That's probably what we need in order for the market to correct itself and for us to really start to get those opportunities back for our clients and for ourselves if we're in the market for ourselves as well. All right, what do you guys think about this? Kind of an eye opener?
Yes.
Hmm.
But a lot of people will be desperate because I had buyers that were pre-approved for 500K.
Mhm.
And now with the new interest rate, when they're actually pre-approval got expired.
Yeah, what happens then? What happens when the approval expires and they have to qualify?
420. That's 80,000 difference.
So they went from 500 to 420?
Yes.
Yeah, so what does that mean now? Now when they had a hard time qualifying for a house at 500, what does that conversation sound like when you have to talk to your client about that? Can you walk us through that?
Yeah, well, they're gonna have to satisfy themselves for a smaller home,
Mhm.
look in a different neighborhood from what they originally wanted,
Yeah.
or townhome. That's always an option, to look for a townhouse.
Mhm.
And when they panic over the HOA fee,
Yeah.
I always get like a breakdown for the numbers. If it's $300 a month, it's $1 a day
Yeah.
for the HOA. So it's not really a big deal, especially if they both work and have no time to shovel snow or take care of the lawn.
Mhm.
You know, they have somebody to do it for them. They got the roof covered, the siding covered. It pays, you know, it's nice advantage to take care and to take advantage of the HOA fees.
Yeah.
So that's it. It's really, I don't know. I mean, we're offering between 20 to 30,000 over asking for townhouses now.
And does that work? And what's been working?
No, it doesn't work actually.
Doesn't even work, right?
We get overbid, yeah.
Oh man, that's not, that's just
Yeah. Townhouses used to be a softer market for us. Like you overbid 10, 12,000, your offer gets accepted, not anymore.
What happens now? Like when a client gets an offer accepted, what kind of conversation do you have with them? Because sometimes they don't realize that, hey, you got your offer accepted. You know, now is not the time for cold feet or shenanigans with the home inspections. Like, do you have a conversation with them that they're very lucky to get an offer accepted?
No, because they're so desperate. They're so happy to get their offer accepted.
They're just good, right?
Yeah.
Yeah.
Because they look at the market. I mean, everybody knows Zillow and everybody looks at Zillow and everybody sees there is no inventory.
Yeah, that's true. There's nothing really out there.
No.
So I'm looking forward to a correction. I know all of you are as well. Like nobody wants to keep seeing limited inventory and 20% year-over-year returns on properties. That's not sustainable. And we need a normalized market. We need, you know, average returns, and we need more inventory. That's really going to help everybody out in the long run, because this is really just like it's.
Yes. So there's a new product that's being introduced by the lenders, ARM. And what do you think of it?
An ARM?
Yeah.
Well, for those of you who are not familiar, or if you recall from your mortgage classes, an ARM is an adjustable rate mortgage. I'm not a fan of them. I'm not a fan of them. The only way I'd consider an ARM is if I was buying a property to hold for just a few years as an investment, and then I was going to get rid of it. That would be the only way I would entertain that. But because what you're doing with an ARM is you're rolling the dice, because you're betting that by the time your ARM is done, that number one, the mortgage rates are going to be lower. That way you can refinance into something more permanent, or
Yes.
B, you're going to be looking for another house to move in the future. That way you don't have to worry about refinancing that mortgage, because you're moving somewhere else anyway. So there are 3-year, 5-year, 7-year, 10-year ARMs, which means that, you know, you've got options. But the shorter your ARM is, the cheaper it is, and the longer your ARM is, the more expensive it'll be. So you're kind of playing that game where, okay, well, if you look at the statistics, most people, not everyone, but most people move every 5 years. And if you think you're going to do the same thing, then maybe a 5-year ARM is not a bad idea. You know, why? What are you seeing with that, Sarah? What are you seeing?
People like it. They're actually, you know, I feel like, I don't know. I mean, I only been doing real estate for a year and a half, but
yeah,
this is something that my broker said that it used to be a very popular product.
Yeah.
And it went away, and now it's coming back. So the lenders are for it.
Oh yeah, of course, because if
You
the lenders
know?
don't have, if they can't qualify you for a house, they're not making any money. Yeah.
Yeah. You know, I mean, like you said, a lot of people move between 5 to 7 years.
Yeah.
So if they get on ARM for 10 years, they're okay, because they'll sell the house before they had to adjust it.
Yeah, I don't think there's a problem with ARMs at all, as long as the consumer, your client, really understands it. Because if they don't understand it and they just get kind of forced into it, kind of like a lot of stuff that was happening back in 08 and 07,
Yeah.
then what happens is that when the music stops, they look for anyone and everyone to blame for their situation, you included, you know. And that's not kind of business you want to run, because then you don't get the repeat business. You're not going to get that
Yes.
listing. You know, you're not going to get any referrals. They're all going to say, you knew about this. And like, and a lot of times I don't get involved in their financing. Like I don't
Yes.
ask what kind of financing you're getting, because it really has been nothing but 30-year fix, you know, for the last better part of the decade. But if ARMs are being rolled back in, I believe that we should do a part and let them and ask at least, are you aware of what an ARM is? Do you know that within that time you refinance and sometimes the interest rate won't be lower? If they understand that, then it's good. Let them go for it. It's their decision. It's their house.
If I could just jump in, Louis,
Go for it, bro.
the last 5 or 10 years, it's hard to imagine a double-digit interest rate on a mortgage. But for those of you who are substantially younger than me, let me just say that my first car I ever bought was in the days of Jimmy Carter era. I paid 18% for that car loan.
What in the what?
18% for a car loan. The first home I ever bought, I paid 13% for the
That's
mortgage.
nuts.
So if you don't understand the adjustable mortgage rate, this ARM, somebody buys an interest rate now, think, oh, I can get in for 5% in a 5.5 or 6% market because of the ARM, but then it goes to a double digit. Those people are going to lose that home.
Oh yeah.
5 years, they're going to lose it. So I would just jump on with Louis and say,
Let the lender handle it.
well, not really, because you're representing the buyer. So you're watching out for them. And we'd all like to sell homes, but our primary responsibility as a fiduciary is to watch out for the best interest of the buyer. So,
And that's my question, Louis. How do we make sure that these buyers understand the ARM? Because I find that they're in this position of like desperation and they kind of hear what they want to hear. They hear anything that's conducive towards them getting the house or the sale being made on their behalf. But I don't know that I know that they really understand what they're getting into.
Yeah. Even though the products are different this time around and the terms are different this time around, I feel like the human psychology is all the same as it was in 2007 and 2008, because they wanted something so bad that they would do anything it took to get the house, right? They would take out these exotic mortgages back in 2007, 2008. This time around, it's even worse in my opinion, because now they're tapping into their kids' college funds. They're taking money, borrowing money from their parents. They're taking money from anywhere and everywhere that they could to put it on the line. And what happens is that when a home loses its value, people start to kind of question, why am I paying on an asset that's underwater, right? That's the psychology number one. And then psychology number two is, what happens if the market takes a downturn and I lose my job? Do I put food on the table or do I pay my mortgage, right? So you start to see how all these things all start with the mentality of that I have to have today. I need it, right? And then what happens is when they get it, it loses its luster. And then when the reality sets in that, hey, maybe I shouldn't have jumped the gun when I did, it's dangerous. So like Brent was saying and Nicole is alluding to is, we cannot control human behavior because people are going to do what they want to do. The only thing we can do is just let them know, hey, do you understand how this works? Do you understand that if the mortgage rates go up and you have to refinance, your rate's going to go up? Can you afford this home if the interest rate goes from 4% to 6%? Can you make that difference? Can you pay that? It's going to be an extra couple $100. Would you be willing to take a part-time job? Would you work more hours? Do you have a child that's about to be of working age that can contribute? Do you have these things that could help you? And if the answer is no, I couldn't afford it at 6%, then hey, maybe you should buy a little bit of a cheaper home, so that way you can, because, go ahead. And so I guess the question is, how do we know? We don't know because we don't really get that information. But if you look at the pre-approval letter, a lot of times states what kind of a mortgage or what kind of a loan they're taking out. Okay. If it's an FHA loan, it's a 30-year standard rate. Okay. If it's a conventional loan, then you've got the opportunity of taking out that ARM. And on there, it'll say a 5-1 ARM, or it'll say, a 7-1 ARM or a 10-1 ARM, those type of things. If you see that, then you may want to talk to your lender first, because obviously you don't want to go against your lender either, and say, hey, did you explain to them what the negative aspect of having an ARM is, what could go wrong? Are they on board with that? Because I don't want this 5 years from now to blow up on them and they come back blaming everyone. Like, did you disclose to them what not just give them a bunch of like 200 pages of disclosures to sign, but did you physically literally speak to them and tell them, your rate can go from 4% to 6%. Did you have that conversation with it? And the answer, if they tell you no, the answer is no, I didn't have that conversation with them. You simply say, listen, would you mind if I did? Because I want them to understand that, yes, they can afford it, but I just want them to know that they have to refinance before that time if the rates are better. If the rates are not better, then, you know, obviously they can let the rate float. And if you guys don't know about ARMs, maybe another day we'll cover ARMs in more depth. But really what it means is that they have the chance to refinance it and get a better rate before the 5 years are over, or they can just let it ride. And if they let it ride, they just have to live with whatever the market's doing. Okay. All right. So yeah, it's kind of it's kind of something you guys need to be looking for when you get the pre-approval letters. You'll probably start to see them now more than ever, you know, but it is what it is. You know, people want to afford their home. So you can't stand in the way either. If they want to do it, let them do it. It's not your job to babysit them either. Cool, cool. All right. Yeah, good topic. Good. Good. I'm glad you brought that up, Sarah. So I want to read this this article that was it Yahoo Finances came out with. It says what home prices will look like in 2023 according to Zillow's revised downward forecast. Okay, so for a company like Zillow to give you a downgraded forecast, it really means something, because, you know, as the CEO of this company, when they have to deliver bad news, they have to use what's called good bedside manner, which means that they can't scare the pants off of you because everyone's going to go running for the hills. But they also can't lie and say nothing's wrong, because then people pull their money out from your company because you don't provide accurate forecasting. So they have to kind of go somewhere in the middle. So I kind of want to go over this article because it really does break down in kind of a shortened way of what we're seeing. Excuse me. So it basically says here first, we have a little bit of an opinion piece. It says, there's no doubt that soaring mortgage rates are an economic shock to the United States housing market. Over the past month alone, the average 30-year fixed mortgage rate has spiked from 3.11% to 5.11%. It's both pricing out some stretched home buyers and causing some would-be borrowers to lose their mortgage eligibility. I know we spoke about that before. It's completely true. The swift move up in mortgage rates also has research firms re-gearing their housing forecast models. Heading into 2022, the real estate research firms presume the Federal Reserve would put upward pressure on rates, but not like this. On the year, the Mortgage Bankers Association forecasted the average 30-year fixed rate would climb to 4%, while Fannie Mae forecasted a 3.3 mortgage rate by year's end. And we blew past both of those estimates a few weeks ago. Now, what they're saying here is that a lot of analysts were thinking that mortgage rates would climb to 3.3% or 4%, but they were all wrong. They had no idea that the Federal Reserve was going to be more as aggressive as they've been recently. So I'm not sure if you guys been hearing a lot of talk in the last couple of weeks about the Fed raising rates and what that means. So when the Fed raises rates, it doesn't necessarily mean that mortgage rates are going up because of the Federal Reserve's overnight banking rate, because really the rates are intended for banks. Okay, what really controls our mortgage rates is the 10-year bond market. And when you see the 10-year bond market spiking up, then you know that there's trouble in sight for mortgages. So recently we've been seeing the 10-year mortgage bond market really at its highest that it's been. Really, I think it's probably the highest it's been in the last 5 years. I'll pull up a chart in just a second, but I wanted to explain that to you because we're way over what they were estimating here, which is, it goes to show you sometimes you really can't really trust even analysts who are paid to do this for a living. So let's continue reading. It says, now the real estate researchers are dialing down their home price forecasts. Okay, so that means that they don't think the prices are going to be going up as quickly. So on Wednesday, Zillow researchers released a revised forecast predicting that U.S. home prices would rise by 14.9%. Okay, so they still think that home prices are going to go up by 14.9% from March, which was just what, last month was that? March? April? No, 2 months ago. So from a 14, almost 15% from March of this year to March of next year. But they had originally predicted that it was going to go up 17.8%. Okay, so they've revised that down 2.9%, which is, I mean, it's not huge and it could still be wrong. So driving the downwardly revised forecast are affordability headwinds that have strengthened faster and expected, largely due to sharp increases in mortgage rates. Further risk to the outlook as well, inventory levels remain near record lows. Yeah, that is true. But we have the potential to recover faster, and and anticipated, which could lower future prices and sales volume projections. All right, I want you guys to take a look at this, this graph that we have right here. This is the U.S. home price growth over the last few years. So as we can see here, 2019 to 20 was pretty flat, and then we had this huge spike up, and right now we're starting to see a slight dip. Now, usually these dips are leading indicators for what's going to happen next. Okay, so they're forecasting that next year the home prices are going to increase by 14%, which I agree. I don't think we're going to see a crash right away or anything like that, but I do think that home prices are going to go up at a slower pace. That's for sure. I believe that's probably pretty accurate. Maybe not in every market, because you guys are, some markets are different than others, but it's gonna over across the country, it might just even out a bit. So let's continue reading here. The fact Zillow has cut its forecast shouldn't come as a surprise. After all, this swift move up in rates is creating a serious affordability crunch for home buyers. At 3.11% fixed mortgage rate in December, a borrower would owe principal interest payment of $2,138 on a $500,000 mortgage. That payment would spike to $2,718, which is that's like $600 more for a family, if taken out at a 5.11 rate. Over the course of 30-year loan, that's an additional $208,000. How insane is that, guys? That is crazy, right? So
Yeah,
unbelievable. They could buy another house.
yeah, true.
Yeah, that's really, really crazy. So right now we're starting to see here interest rates spiking up, like higher than they've been even since 2017. Higher than they've been in the last like 5 years. You can see here at 5.11%. And guys, I think that 5.11% is just the beginning. I think we could hit 6%. 6% is very reachable, obtainable. I think that's could be where we could be headed in the next few months.
We're not that far from it.
Not.
It's 5.5 now.
Is it 5.5? Yeah, we're not that.
Yeah, we're not that far.
Yeah, that's crazy. Let's see if we can pull up some more information here. Of course.
Louis.
Yes, sir.
Yes, it's John here, and
Hey, John.
just wanted to, talking about the crazy market.
Yeah.
This last weekend, really God showed up for me, and I had my first, interview with, potential listing in Baskin Ridge.
Oh, congratulations.
And,
Good
thank
job.
you. Yes, and when we were going through the comps, it was me and my mentor. Both of us went to this, to the presentation. It
Yeah,
went
great.
very well.
Uh-huh.
We couldn't find comps for this area of Baskin Ridge, and we finally found something. And believe it or not, there is a house that sold 2 weeks ago that had been listed for $659,000. This is 2 weeks ago, and it sold for $750,000.
So 100,000 more than was listed for.
100,000, and this is a conventional loan. Unbelievable.
Yeah,
and
I believe it. Please believe it.
Yeah, so there is the market. It's very unpredictable right now. There's no format to it. There's no formula to it, and my client was like, "Oh my gosh, this is exact house like mine. I mean, no difference." And so there's a potential for us listing her house, but the question is, are we going to get 750, because that's what she wants, of course. We only had 3 comps for the whole area. But then fast forward last night, I get another call, a text from a good friend of mine who lives in the same neighborhood, but a different town. And he calls me, he's like, "John, I want to list my house with you. I'm moving out of the state." His house is it's worth about 800.
Okay.
And man, I got goose pimples. I was numb. This is 11 o'clock at night. I didn't sleep well last night.
You're nervous.
yes, and also excited. But to me, it's crazy out here.
Yes, it really is. You
Uh,
can't.
John, just be happy. You're on the listing side.
Yeah, a lot of people.
You're a king. You're sitting on the throne.
Yeah,
Well, I'm trying, but I'm just, I'm learning. I'm in the, I'm in the learning period of time, and it's just, it's mind-boggling to see all the price and the craziness that's going on out there.
Oh, what I know, I think I have a buyer for your Baskin Ridge house.
Okay, we can talk then.
I'm sure,
Yeah.
I'm sure every real estate agent in Somerset County has a buyer.
I'm gonna be one of 100 people coming.
Nice job,
Okay.
John. Congratulations on that, brother.
Thank you. But Luis, really, what I want to say here, there's many other reasons why people have to sell despite the interest rate, because these people out there who have lost loved ones, like my client, and her financial advisor is telling her she has to sell. It doesn't. I mean, they're not looking at the interest rate at this point. I mean, it's either she sells or because she cannot afford to live there anymore.
Mhm.
And she has to
Necessity.
downsize. There's divorce, people who have to, to separate. There is retirement. There is people that have to relocate because of work. So there's all kinds of reasons why people have to relocate.
Yeah.
Yeah, and so there will always be somebody selling and somebody else buying.
Yeah. What I learned a long time ago, thank you for that, John. I appreciate that, is that real estate is not a trend. Even though there's trends in real estate, real estate is a necessity. No matter what the market's doing, somebody has to sell, someone has to buy. Even though there might be more buyers and sellers in certain times, real estate is a necessity. Okay, it's one of the things we need for survival. So even though we sometimes think there's trends in real estate, there's always opportunity, there's always buyers, there's always sellers. So great points, John, on that. And one thing that I'll add to that is, guys, remember, right? Not everybody is experiencing a pay increase. Not everybody is. Not everybody out there who owns a home got a 20% increase in their earnings last year. But guess what is up 20% year over year? Gas prices, food prices, entertainment prices, like all of these things that normally, like the other day, I went to the car wash and I have like this unlimited car wash for $20 a month. And it's like the best deal ever because I could wash my car every day and only pay $20 for the month. Not that I do, right? But if I had that much time. But what I experienced the other day is I drive through and they change their pricing to $25. Now, an extra $5 may not seem like a lot for what you get for washing a car, every day if you wanted to. But if you think about it, that's a 25% increase in price for the same service that I was paying for, a month ago. So everything is going up, every single thing. And if a family is experiencing 20% more of expenses year over year, they might not be able to afford their home anymore. So those families might have to sell, not out of necessity or vanity because they want a better home. So maybe they're priced out of their market and they have to move into a less expensive market. It's unfortunate that has to happen. But like John says, it does happen. Sometimes people just can't afford it anymore. They lose a loved one or someone gets sick and they have to pay for hospital expenses. So yeah, good point, John. Like not everyone just sells because they want to take advantage of interest rates or the market. Okay.
Louis, I have a question about the video that you just showed us. Yeah. So according to the numbers, the prices are going to, the home prices are going to go up in 2023.
Yeah, it appears almost 15%.
But are they going to be priced right to sell, or the buyers are also going to drive that up as well?
Are they going to be priced right to sell? I'm not sure what that means because remember, guys, right now you guys are creating comps that are way higher than they were a year ago, right? You guys are creating a floor. Some people are buying cash and they're creating these inflated comps. Some people are paying a difference out of pocket, creating these inflated comps. So it's safe to say that in some of those markets, you're going to see an additional 10-15% increase from where they are today. It's the insanity is not going to stop overnight. It's going to take a little bit of time to slow down. But yeah, I think in the more affected markets, you may see less of an increase, but in maybe the lesser affected markets, you'll still see a 15% increase, because 15%, if a home is on average 100 grand in a market, it's easy to go up 15%, right? It only has to go up to 115. But if the average price in an area is $1 million, well, it's a lot harder to go from $1 million to $1,150,000 than it is for a house that's 100 to go to 115. So it's not going to be exact in every market. It's going to be different in every market, but they're estimating that about 15% across the nation is what you'll see. Was that your question, Sarah?
Thank you.
Okay, one last thing I want to share with you guys, and then we'll just close out. Maybe you guys have some final thoughts. So remember what I explained to you guys earlier, that the interest rates are calculated by the 10-year bond market. So on my screen right now, I have a graph for the 10-year bond market, right? All the way back to 1981, right? So 1981 is right in here, guys. So like Brent was saying, interest rates back then, sky high. People were paying 18, 20% interest rates for their house, right? And right now we've seen that we've had that gradual decline in bond rates from 1981 all the way down to where we recently were. Right here was the low, and I'm on a monthly chart. So every one of these candles that you see represents a month. So the lowest we saw the bond market go to was in March of 2020. That's when the pandemic broke out. Okay, that was like the scariest of scary times. And we reached a floor of 0.35% on the 10-year bond. Since then, we've been experiencing a pretty healthy recovery. We had a little bit of a dip in this time frame here, April 2021, and then we've seen a resurgence ever since then. So what you're seeing right now, and if you guys don't understand how graphs work, there's a lot of technical traders out there that trade bonds and trade stocks and stuff like that. So what you're going to see right now is that you're going to see a slight pullback right here where we are currently right now at 3.11. Why? Because there's resistance here from where we had levels before. So what people do is that they sell off their bonds here because they know that they can get a premium for it, because it'll probably come down a bit and then it'll come back up. But what I want to show you is that we're still historically over the last 30, 40 years, we are at the lowest that the 10-year bond rates have ever been. So as this 10-year bond rate goes higher, which it will, it's going to bounce around here for a little bit, but it's going to break through here, and then it's going to hit its next level of resistance, which is somewhere just around 4%. So 4% would really bring us back to that 6-7% level in interest rates. So if we see this break out, the next logical stop would be right around here. These are both technical, and these are also Fibonacci levels of how bonds and stocks usually trade. So I wanted to show you this because I want you guys to visualize that we are historically still at very, very low levels. And if we just find equilibrium, if we just find our way back up to where things normally are, we're going to see interest rates climb back up. And when those interest rates climb back up, eventually prices have to settle down, inventories have to level out, and things have to come back to normal just a bit. So just wanted to share that with you guys. All right, let's see.
This was very informative. Thank you so much. Lots of updates, lots of information.
Well, thank you guys for being here. Anyone else want to add anything before we go? All right, you guys have been amazing. Let's go ahead and close out with our prayer. Dear Lord, Father in heaven, we thank you so much for having us here today. Lord, we thank you for giving us the ability to learn from each other and hear each other's experiences. Father, we ask you that no matter what is ahead of us, no matter what the interest rates or the housing market does, Father, that you allow us to go out there every day, Father, and put our best foot forward to help families and to be there and guide people in the right paths. Father, we know that without your help and without you by our side, none of this would be possible. So we ask you, Father, to always keep us healthy and keep our minds in line with what our mission is with you, Father. Father, we ask you to please look over our families and look over our health and safety in the days to come. And Father, we ask you to bring us back here in one piece, healthy and safe next week on Monday. In Jesus' name we pray. Amen. Thank you, everyone. Have an amazing day. Hopefully you guys.
Thank you, Louis.
Amen. Thank you, Louis. Have a good week, guys.
You as well. You as well.
Take care.
Thank you. Have a good one.
Bye-bye.